Fitch Ratings has revised India's GDP growth for FY26 to 7.4%, driven by strong domestic demand and tax reforms. Inflation remains low, giving the RBI room for a possible rate cut. Fitch Ratings revised India's GDP growth forecast for FY26 to 7.4% from 6.9% projected earlier. Private consumer spending is the main driver of growth. Increased consumer sentiment and tax reforms also have provided support. India's growth is expected to ease to 6.4% for FY27. India's inflation is expected to average at around 1.5% this fiscal, and the rupee is to strengthen next year to around 87 rupees for the dollar. Well, Dr. Charan Singh, eminent economist and CEO of eGrow Foundation, joins me now to help us, break this down. Dr. Charan Singh, what specific macroeconomic policies, or let's say, or indicators have made Fitch think this way?
The most important indicator is the GDP growth. Against all expectations, every pundit, 8.2% is amazing growth. So therefore, it surprised everybody that how could this high growth be there? The Reserve Bank, the IMF, and even in private conversations, and even in the local newspapers, many of the Indian economists could never think that it will touch 8.2%. Not only it has touched 8.2%, it has gone from 7.8% that it had recorded in the first quarter. All these are much beyond the expectations that the Reserve Bank had been forecasting. We are going to have the Reserve Bank's forecast tomorrow.
Yes.
Let's wait and see how they do it. But I am sure the Reserve Bank is also going to increase its forecast for the year. Now, why is this all happening? Couple of things. One of the things is that the very good, robust, well thought of strategic policies that have been announced by the government since COVID and even during COVID, wherein they announced certain policies which were of immediate effect, but many of them were staggered in a way that they had huge multiplier effect because they were capital investment oriented, where the multiplier effect is high and it shows up over a period of time.
Okay.
That's one thing. Then they went in for the direct tax code, then the GST. Now,
Right.
the GST reforms that have taken place in such a way, it's pure, I would say, the way the whole country, the state finance secretaries, I call it the fiscal cooperative federalism that we have here, is showing up. The rates have been revised sometimes towards the end of September. You will start seeing their progress now in the next quarter. So the expectation is that 7.8 in quarter one, 8.2 in quarter two. Quarter three is a busy season full of festivals. I'm sure it's going to be higher. Monsoon is behind us. So we are going to really clock very high growth in quarter three and quarter four. That brings me to my most important hypothesis. India has the potential to easily touch growth between 8.5 to 9%.
Okay.
Given the right strategy, the right direction, and I also think the right confidence, we will be able to touch it. That's
Indeed.
what is happening.
And talking about the right strategy, well, the government has been investing heavily in capital expenditure, infrastructure, and that has been driving growth. That's a key multiplier. The services are growing very rapidly, but manufacturing seems to be, a little slack, maybe because there are certain issues. How would you look at, sectors? Will sectors like manufacturing also pick up because of this growth?
See, my own feeling is manufacturing is not that slack. That's okay. I think if you look at the H1 data, 4.8 to 8.4, I think that's reasonably good. Of course, I don't deny the fact that financial sector, real estate, and those services have touched 9.9. I don't deny that. You yourself said services are doing good. Now, my own feeling is that with the rate of interest being lowered, and I'm expecting another lowering of interest rates tomorrow, with the rate of interest being lowered, you will find that private sector investment will also go up. What you mentioned just now is the government capital expenditure going up, and government capital expenditure, of course, has been in infrastructure, roads, network, and highways, as well as the airports. They have huge multiplier effect, but the private capital expenditure, which has been little shy, should now
Okay.
come up.
Indeed.
And with the lowering of the interest rate, this will get a further impetus. The
Sure.
consumption demand in the economy is solid. So once the consumption demand is there, the manufacturing sector knows
Right.
that there is consumption demand. Obviously, they know their
Sure.
production is going to get absorbed.
Dr. Charan Singh, we're running short of time, but one quick question, about this upgraded forecast. How does it position India, globally? And are we likely to see a lot more investment coming in?
Absolutely, it places us in a very good position. As it is, we were the largest, we were the fastest growing large economy. And over that tag, we have something more now. So obviously the FI is going to come in. Our own lowering of the interest rate means there's lots of energy that's going to get generated within our country. So I'm looking at a very good Q3 and Q4 performance, better than what we have done in the past.
Okay. We leave it there. Thank you very much, Dr. Charan Singh, eminent economist, CEO of eGrow Foundation. Thank you for putting the Fitch rating upgrade into context for us.